A friend of mine works for Rivian. I asked him if he has thoughts on their expected IPO valuation of $80 million. He said, we have not delivered one car yet, not one. Yet we're asking for a valuation that's greater than that of GM, a company that sells 7 million cars a year. If the markets want to give us $80 billion, we aren't going to say no. I already have my boat picked out. Public companies can create money out of thin air using valuations. The traditional way to billions is to either inherit or marry up or win the lottery. Now the journey to fulfilling that American dream is to start a company, raise venture capital, and continue to raise venture capital until you IPO for billions. Let's follow this journey from start to finish. Hi, I'm Bharat Kanodia. I have valued over 2,000 venture-backed companies and witnessed their journeys from zero to IPO. I tell founders and investors what their companies are worth. Venture capitalists are not looking to invest in companies and run them into perpetuity. Their business model is to invest in numerous companies, double down on companies that do well, and sell them for a big payday. The only way this model works is when their portfolio companies are successful in raising capital at higher and higher valuation. Say you start a company and are among the 2% of the startups that successfully raise capital. Say you raise $2 million in Series A at a $10 million valuation. That $2 million is going to burn really fast, and you're going to have to go out and raise capital again. But next time, when you raise capital, you're going to have to justify at least a $20 million valuation to retain investor interest. After 4 or 5 times of successfully raising capital and increasing your valuation 3 to 5 times at each raise, you are now valued at $1 billion. Such companies are called unicorns and are strong candidates for IPO. Private company investors are incentivized to push valuations higher at each funding round to show appreciation of their assets under management. And since private company investments are outside the purview of regulators, investors have a free rein on valuations. I have valued WeWork for one of its venture investors, who was very bullish on the company and insisted that the company is worth 60% higher than what I had concluded. I made a comment that WeWork's business model is the same as Regus Space. My client did not like my comment. 6 months later, WeWork's valuation dropped from $47 billion to $12 billion, and the investors had to take a 70% haircut. Today, WeWork is worth about $9 billion, 80% lower than the original $47 billion valuation. The disconnect happens when the company IPOs and all the traditional methods of valuation, the income, market, and costs, start to come into play. As a valuation expert, if I were to value a pre-IPO company like Rivian or WeWork, I cannot justify their valuations just using traditional methods. The fact is, pre-IPO valuations are inflated for 2 reasons. 1, private companies' investments are unregulated. 2, private investors use non-traditional valuation methods, highlighting the potential future growth of their companies. If you can convince investors and markets that your company will show exponential growth, they will give you a valuation that may touch 10 digits. By highlighting growth story of your company, you are almost legally printing money. So the next time you're enticed to invest in an IPO, ask yourself 2 questions. 1, how much of their valuation is based on future growth? 2. How does a competitor's valuation stack against theirs? A Hollywood set is also built by creative and ambitious people. It is temporary and designed for a specific purpose. It is a two-dimensional object in a three-dimensional world, just like a pre-IPO valuation. Thanks for watching.